Let's move right on to Page Industries, talk a little bit about the demand picture, the impact of expenses as well as the margins. We have Chandrasekhar K, who's the CFO, joining in. Thank you so much for taking time out and joining us on ET Now. It's not often that we get to speak with you. Let's begin by talking about your performance. Margins and profits have dipped due to the higher expenditure in sales and marketing. And in the presentation, you called it a temporary blip. So do we expect these expenditures to normalize soon? And how long exactly is temporary?
There is a temporary dip in PAT, and that is because of the investments we have made in sales, marketing, in people and technology, and we have senior people on board. So this is the only way to drive sustainable growth for us in the future. And also in terms of volume, the revenue growth, if you see, we have only grown by 7%, both Q3 and for 9 months. So our expectation of volume was much higher. So if we had the volume growth in the mid-teens as we used to have, all of these expenses would have been fully absorbed and we would have been able to achieve those margins. So presently we are in a sluggish phase as far as demand during this year. But whenever that returns, we will be back to the margins that we have been delivering.
Okay. By when do you expect the situation to normalize? Would it be fair to expect margins bouncing back to previous levels of 20% plus anytime soon?
Definitely the margins would bounce back. But then the growth has to come in the demand. So definitely we are looking at FY 21 with much more planning and optimism than we have it now.
And does demand continue to be as weak in Q4? What's your sense, from the grassroots? Is the worst over?
We don't approach market only from the margin perspective. Our strategy has always been to invest for the future growth. So we have an extremely strong balance sheet, and we are debt-free, and we are able to invest to create that growth. So the market demand being whatever, that we are operating in an economy, the macro situation will affect everyone. But we are in an under-penetrated premium apparel market, and there is multiple opportunity for us to grow. So we have been expanding the presence and distribution in exclusive business outlets, and we are continuing to invest in technology, as I was saying.
Okay. Now, the street is expecting the industry to grow by 10% in FY21. Do you concur with that? And how do you see Page Industries growing vis-a-vis the industries? Can you give us some details on that?
Volume growth is of double digit is something we always plan for. That is the way we prepare the organization, both the back end and the front end in terms of channel and distribution. So yes, the FY21 should be better than FY20, but I'm not too sure whether it will be a 10% growth for the whole industry and for everyone. We have to wait and watch in Q4 as to how the demand pattern turns.
And competition also is getting aggressive. You've got the Birlas pushing the Van Heusen brand, and then there's the likes of Hanes, etc. So how are you protecting your market share? What's the strategy in place?
We don't look at it as a market share. What we look at is, because it is an under-penetrated premium apparel market, we look at it as penetration levels. The penetration into the premium market is of the order of 20% in premium innerwear. We have in the men's innerwear, we have a penetration of close to 6 to 8% in the women's market, as well as in the athleisure, which is the activewear segment. So the market has been there, competition has been there. We have been in business for the past 25 years in India. Competition has been there these past 2 decades. Some have come, some have disappeared, some people have stayed. Our approach has always been to grow the market. We respect all the competition and we do learn from them. But it is not a an impediment as far as our plans to grow.
Okay, and on volumes, they remain volatile recently. Raising questions over the two pillars of Page's peak narrative, that the company is economy proof and that the company is competition proof. Is the concern justified?
Let me say that no company will be economy proof, and Page is also an example because we had almost double-digit volume and revenue growth in the past. So we have also been subject to the demand and consumption story being sluggish. But the differentiation as far as Page is concerned is that, as I said, we have a strong balance sheet. We have a very large consumer base. We reach out to more than 63,000 retail outlets. And so we are able to withstand the slow phase. And that is the reason we are able to invest. We have confidence and the optimism that the market will return with respect to the growth. And we will be able to stay and succeed. We can say that as to competition, we can say that when we say that we are our own competition, what we mean is that having been around for 25 years, we are able to improve on our value for money proposition in the premium quality apparel space. And because this market is under-penetrated, we are the best place to take advantage of that.
You're expanding a channel presence in exclusive business outlets. Does it mean you'd be reducing focus in small outlets? What's the difference seen in returns from EBOs versus small multi-brand stores?
In terms of consistent growth across channels, each channel is treated separately. We have 720 exclusive business outlets, what we call as EBOs. And we have a target of reaching the EBOs to 1,000 plus, which will possibly happen in FY21. The MBOs are also growing. We have a large penetration, meaning in terms of new stores getting opened. So that is also happening. So we have to reach out to the consumer base, and we're continuing to do that. We also are present in large format stores as well as on e-commerce. All these channels are continuing to grow.
Okay, so tell us a little bit about your plans to enhance distribution. Is this going to be the new pillar of growth?
We serve 63,000 retail outlets, and these are serviced by about 4,300 plus distributor accounts. So the distribution is growing all the time.
Now, Speedo hasn't picked up in India as yet. When do you see it contributing meaningfully to Page Industries? What are your plans to expand beyond the Chucky brand?
Swimming is a sports activity, and it is still at a nascent stage in terms of widespread acceptance by the entire population. So the access to swimming is not available to everyone, you know that. And but Speedo International, whom we represent, has done a market study. India is the fastest growing swimming market. Therefore, we are present in 1,300 plus retail outlets and about 44 EBOs. And we are taking all the steps to improve the market reach. And of course, looking at Speedo and the niche market that it is operating in, it cannot be as big as Jockey, but it has its own place. And it's also the first few years of operating in India.
Page has been aggressively working on ramping up the kids' clothing portfolio. You set up an independent sales team for that. So what's the acceptance been like?
The acceptance has been pretty good. We have seen growth in business by almost 45% this year. And we also, as you said, we have created a separate channel for kids, which means right from the country level to the field, we have 100 plus strong sales force. We also appointed Jockey Juniors, specific channel partners in 50 cities, and this is only the phase one. We're also planning to open exclusive Jockey Junior EBOs in the coming quarter.
Thank you so much for joining us, Mr. Chandrasekhar.